to welcome in our next guest. That's Mark Matson, the CEO of Matson Money. Mark, this is a really interesting market, right? It seems all the headlines, super negative all the time. We're climbing this wall of worry. We had the huge flush, but we came back with a force that I don't think many saw coming. What do you make of the market's performance over the last month?
Well, I'm a long-term investor. I try to not get trapped up in the short-term noise of what's going on. But you are right, Alex. There's a lot of fear in the market right now. There's a lot of fear about tariffs. There's a lot of fear about whether or not Trump's tax bill will go in and taxes will remain low. There's fear about the deficits. Obviously, there's been market volatility. Year to date, how do you deal with uncertainty? The best way to deal with uncertainty is diversification. And most investors are dramatically under-diversified. They find themselves really tight with the S&P. They find a lot of Mag 7. They find a lot of technology. And while history may not always repeat itself, people that don't learn from it are doomed to repeat it. And from 1995 to 2000, large stocks made 22% per year. Tech stocks made 45% a year. But after that, Alex, people forget that large stocks lost 50%. Tech stocks lost 75%. They're not globally diversified as a community of investors, and we analyze portfolios all the time of investors, and they don't have enough high-quality short-term fixed income. So most investors have really set themselves up. If this market does continue to do bad over the next year, they've really set themselves up for disaster.
This is a really, really important conversation because I think the sort of armchair definition of diversification, if you were to straw poll someone on the street, is, oh, I own Apple, I own Microsoft, I'm diversified, two different companies. But the reality is those two companies move in lockstep more often than not, and that's not real diversification. What you're talking about is look to other marketplaces. Look to other assets altogether. So for those who maybe look at this concentrated portfolio and they're, exhaling that they've gotten this recovery to some extent and maybe have been given in some ways a gift of the market to reconsider their positioning, what are some things in other places that maybe are worth considering adding to get that true diversification that you're describing?
Yeah, so that's a great question, Alex. So look, most people, when we analyze their portfolios, are in the S&P. Even if you're in the S&P, forget the Mag 7, just the S&P, the stocks in the S&P are highly correlated. As you pointed out about Bitcoin and stocks, they're correlated in the ballpark of 0.9%. I mean, they're almost identical. So you're not going to get much diversification there. You have to add asset categories that have low correlation to your main asset category, which is probably going to be the U.S. So you need to look at microcap stocks. You need to be looking at small value stocks in the U.S., but you got to diversify internationally. Large international value stocks right now, as of year to date, are up 20%, and the S&P's only up 1%. So few people have large international stocks in their portfolios, but you also have to have small international stocks, emerging market stocks. We're in over 78 countries with 27,000 individual holdings. And without that type of diversification, when the U.S. does terrible and the S&P gets clobbered, you're going to line up to get clobbered too. You need much more wide diversification than most people have.
Yeah, and I think some people would say, well, hey, Mark, you just described that outperformance. That's awesome. Had I been in that position before, did I miss that trade? And I think you might say, hey, you were just describing some of those longer periods of outperformance, underperformance. Some of these macro shifts are inherently two-decade-like cycles. What would you say to that investor who is caught in the short term and saying, hey, that 20% divergence, I missed that trade?
Yeah, wow, what a great question. So look, as an investor, I know it's hard. But as an investor, you need to be looking for the next 20 years, not for the next 20 days or the next 20 seconds. And historically, there have been whole decades. The decade of 2000 to 2010, the S&P lost money for a whole decade. While small U.S. stocks were up 8% a year, emerging market and international stocks were up for a full decade versus the S&P. So you really want to look at structurally, how am I going to build this thing? If your portfolio has to have a prediction to work, it's already broken. So don't worry if you think you missed it, that last 20%. You know, you need to be looking for the next 10 years. And here's another warning I want to issue to investors. Look, our previous guest, I think he had a lot of great things to say. One of the things you guys were talking about was the yield curve. Look, the yield curve is very flat right now. So the long bonds at, 30-year bonds at 5%, if you buy a long bond and interest rates just go up 1% or 2%, you're going to take a massive hit on 30-year bonds, even 15 or 20-year bonds. The portion of your portfolio that's fixed needs to be high quality, short-term fixed income, because if the market does drop, then you're going to have assets very lowly correlated with the S&P and with international stocks. You could sell off that excess, then buy the stocks while they're low, and you find yourself doing the exact opposite of what everybody else is doing. It's easy to say. The discipline is extremely hard to apply. It's like a diet. Eat less and move more. Most people do the exact opposite. They know the rules, but they're hard to follow.
Yeah, I think also, too, the thing I would add to that price risk component of, treasury investment or fixed income investment in general is, there maybe isn't principal risk if you actually buy the actual fixed income product at the auction or secondary market, hold it to maturity, although 30 years is a long time. But so many are using investment products like ETFs and other funds to track those. You have exposure to those price risks, and that's important to note. You do got some thoughts on things that you don't include in terms of diversification. Why don't you give our viewers some of those things that you're referring to in your notes as toxic investments?
Yeah, so look, Tony Robbins just wrote a book that basically said the holy grail of investing. And basically what he says is, if you want to be a billionaire, invest like a billionaire. This is probably the worst advice I've ever heard. For every billionaire that bought real estate or bought Bitcoin or bought hedge funds, you have tons of people that tried the exact same thing and went bankrupt. So right at the top of my list of toxic investments is Bitcoin, cryptocurrency in general. There is no there. Look, when you buy stock, you own part of a company. When you buy bonds, you own a promise from the company or the government that they're going to pay you back. When you own Bitcoin, there's nothing behind it. It's all based on the bigger fool theory. P.T. Barnum said there's a sucker born every minute. You got to find someone behind you that's willing to pay more money for something that doesn't even exist. The right price for all cryptocurrency is zero, and people will say, well, it's an all-time high. Well, so was the market in 1929. So was tulip bulbs in the 1700s. Just because it's at an all-time high doesn't mean anything about it, other than there's a lot of foolish people speculating and gambling. Gold is another one. Gold historically has only averaged about 5% with a volatility greater than a stock. Stocks have averaged 10 to 14% historically. Very dangerous, very volatile. Bitcoin's very dangerous, and hedge funds in general you're paying 2 and 20. You're paying a massive amount of fees. And look, if these guys knew how to make 20 or 30% a year without risk or massive volatility, they wouldn't let you in the game. They'd keep all the returns for themselves. So watch out for those three things.
Yeah, I love the call out too of the not just, hey, just because a billionaire is doing it doesn't make it a good idea. A lot of those billionaires actually made their money somewhere outside of investing, most of them, I would say. So maybe follow them when you're talking about entrepreneurial advice, but maybe not always investment advice. Mark Matson of Matson Money, I really appreciate it. A great conversation here to set up the show.